Welcome to the Daily AI News Digest. Today is May 22nd, 2026. Before we get started, a quick thanks to our sponsor, bestai.org. All right, in today's explainer, we're going to cut right through the noise and look at the actual, factual developments driving the tech and financial sectors today.
Here's what we're looking at today. We'll cover the biggest market moves and IPOs, dig into some hard product and hardware realities, check out the latest on regulation and business signals, and then wrap up with the analyst's take on what this means for valuations. Let's get right to it.
Part 1. Biggest moves today. We're tracking the flow of capital and impending IPO filings.
So, the AI ecosystem has officially shifted. We're moving away from that purely speculative development phase and right into high-margin monetization. And you can see this materializing in a really compressed 6-month IPO window. We've got SpaceX looking at a June listing, OpenAI prepping a confidential S1 for September, and Anthropic targeting October. These are literally 3 fundamental pillars of the industry, all marching toward the public markets at the exact same time.
First up to open the books is SpaceX, and they are targeting a massive $1.75 trillion valuation. The filing lays out some pretty stark realities, though. CEO Elon Musk is keeping 85.1% of the voting power. And look, while Starlink is actually operating profitably, they've got about 10.3 million subscribers globally, the broader company still posted a $4.3 billion net loss in Q1 alone. For institutional investors, this really underscores the sheer immense capital burn required to build global AI and satellite infrastructure.
Now, contrasting that heavy infrastructure play, let's look at the 2 leading frontier labs. OpenAI is eyeing an $852 billion valuation, backed by a $25 billion revenue run rate. Meanwhile, Anthropic is out there raising at $900 billion. But here is the crucial detail. Anthropic is projecting a $559 million operating profit for Q2. That would be their first profitable quarter ever, arriving a full 2 years ahead of schedule. This is a huge signal because it proves that high-margin monetization isn't just a theory at the frontier layer, it's actually achievable. And that sets a very real benchmark for the broader market.
But here's where these IPOs actually connect, and it's buried in the related party disclosures. Anthropic is paying SpaceX $1.25 billion every single month just for compute capacity. Stretch that out to 2029, and you're looking at a $45 billion commitment. It's a crystal clear indicator of the enormous capital needed to keep frontier model development moving forward.
Moving on to Part 2, Product and Model Realities. Let's break down the factual shifts in hardware and developer utilization. We're seeing a hard pivot from standard chatbots to complex, agentic workflows, AI that basically acts independently. And that shift is forcing a total redesign of data centers. Enter Nvidia's custom Vera CPU. It's now in full production, and it's purpose-built to eliminate the memory bottlenecks that traditional servers hit when AI tries to do long-term reasoning. We're talking 1.2 terabytes per second of memory bandwidth, giving a 50% performance bump per core. It's currently being hand-delivered to Anthropic, OpenAI, SpaceX, and Oracle Cloud. This hardware evolution is a direct required response to the massive compute demands of autonomous AI agents.
But while the Western labs are locking down premium hardware, actual developer utilization is shifting geographically. If we look at the weekly token traffic on OpenRouter, Chinese AI providers have rapidly captured 60% of all routed tokens. Just look at Xiaomi's MiMo V2 Pro model. It alone commands 21.1% of the market share. That completely dwarfs OpenAI's 7.5%. And the data indicates this migration is being heavily driven by coding workloads.
The economics behind this shift are, frankly, pretty straightforward. Let's say you want to run 10 standard evaluations. Using Anthropic's Claude, you're looking at a bill of roughly $4,800. But if you execute that exact same computational work through Zhipu's open-weight GLM model, it's just $544. That means identical workloads are currently nearly 9 times cheaper when you route them through Chinese models. For developers trying to scale high-volume enterprise applications, a cost differential like that is just impossible to ignore. Part 3. Regulation, Policy, and Business Signals. Here's a look at the day's legal shifts and institutional investments.
Over in Washington, President Trump has officially hit pause on the White House AI cybersecurity executive order. This order would have established a voluntary 90-day pre-launch review framework for frontier models. Reporting tells us this delay is stemming from internal disagreements over how these compliance measures might negatively impact U.S. competitiveness against China in the sector.
Looking at the corporate sector, we are tracking 4 major business signals today.
In entertainment, Spotify stock jumped 14% after they inked a landmark AI licensing deal with Universal Music Group. Over in enterprise software, Microsoft and EY just committed a cool $1 billion to deploy agentic AI. Structurally, Meta is letting go of 8,000 employees as they pivot toward leaner AI-augmented teams. And finally, in finance, JPMorgan Chase is formally reclassifying AI as core infrastructure, allocating $19.8 billion to its tech budget.
Which brings us to part 4, the analyst take. Why does all this matter right now for macroeconomic health and frontier valuations? So here is the core, unvarnished question facing institutional investors today. Will cheap, accessible open-weight inference, meaning models you can just openly download and run, erode the pricing power needed to sustain these massive $800 billion plus frontier valuations? I mean, if developers keep routing their standard tasks over to cheaper models, the high-margin assumptions holding up those upcoming OpenAI and Anthropic IPOs are going to face some serious compression.
And listen, this isn't just some theoretical threat floating around. It is actively being priced into the private markets right now. Chinese open-weight provider Moonshot AI just closed a $2 billion funding round, putting their valuation at $20 billion. How did they pull that off? By capturing enterprise demand through ultra-low-cost APIs, pushing them to $200 million in annual recurring revenue.
A CNBC investigation published this week really hit the nail on the head. They pointed out that as the addressable market willing to pay premium prices shrinks, the margin assumptions behind these massive valuations compress right along with it. The reality is, enterprises are actively prioritizing predictable lower costs over marginal gains in peak benchmark performance. The foundational economics of the AI sector are being rewritten in real time.
So, that leaves us with one final, provocative question. As this 2026 IPO window officially opens, will public markets ultimately reward the compute-intensive frontier models, or will the capital flow toward the brutal efficiency of open-weight economics? That's the definitive data point the market is watching next. All right, that wraps up today's Explainer. Thank you so much for joining us. For continuous coverage and to dive deeper into these numbers, make sure to visit our sponsor, bestai.org. Catch you next time.